You cannot call it expense until she's no more. Expense, okay, is when it's no more to do that. That's theory. That's theory. It becomes very important in your IRS debate when you do your income taxes. Talk about it. But I take this piece of chalk. I take this piece of chalk that is now 5 inches long, and I'm in the business of giving lectures. That's my business. This is a supply. I come in here, and I put all these really wonderful notes on the board. And now it's 4 inches long. It's 4 inches long. All right? Okay. How much is the expense? $1 is the expense, but I still have $4 in capital outlay. It's still called an asset to do that. Right. Now, okay, so it's on the board. Now the expense, I take this and I erase it off here, and I come like this, and I says, now where's the expense? Yes?
I was just going to say, theoretically, it's still on the board.
Still on the board.
It wasn't an expense to erase it.
Till I erase it. It's right here, right? Now you could say, no, it's still there, IRS, it's still there. Okay, so I could pound it into the tray, and you say, no, it's right there. And I go, and then the IRS says, oh, it's in the air. He says, go get a lawyer. Okay, we're going to debate this issue when it became an expense. Now, that's it. Let's say that I'm going to have a company party. So the using up of an asset is when the expense occurs. You guys are misusing that word because you go down to Walmart and say, boy, that was an expensive pair of pants I bought. No. It was costly. You see? It's not expensive because you still have it. You're still wearing it. It's not used up. You cannot say expense anymore in this language until you actually use it up. But then you start to fudge with the IRS later on, and you'll see that, well, it's a cost, but I'm going to call it an expense. And the IRS says, all right, this lawyer stuff is getting us, so they'll let you do that. All right? Now, let's say I'm in the business of companies. We're going to have a company party. And so I go down the company, and I get this I get these chocolate chip cookies, all right? Chocolate chip, and I buy a big gallon of milk. It costs $2. It's still $2 because it's easy to divide it, all right? And then it's really more than that. But I take this, and it's really frosty cold. It's got little beads of water on the outside, okay? And you got this glass, and you pour 1/4 of that milk into this frosty mug. Okay, you got it? Now you take those chocolate chip cookies. And at this point, I always take a poll. How many in here are dunkers and how many are washers? Are you a dunker? It means you dunk the chocolate chip cookie and then eat the cookie and wash it. Or do you eat the cookie and wash it like that? You a dunker? Okay, how many are dunkers? Okay, Blanding? Okay, you got dunkers? All right. Now
some dunkers.
You're a dunker? Okay, throwing. All right, good. You're a dunker. Now watch me. That's 1/4. How much milk have I poured into that tumbler? 50 cents. Is it an expense yet? No, it's not yet. Now I take it. You can argue this all the way through, but watch. I take that and I go back and I just chug the whole milk down. Is it an expense yet? Yeah, you can see how you could argue that one. Okay, you could argue that all the way through the system. But we're going to say at that point it becomes an expense. Why? Okay, now I'm going to give you a definition. Another definition you might read in the book. It's called the consuming of a cost. You get it? The consuming of a cost. The cost was what? $1, and the cost was $2. I consumed 50 cents. As I consumed the cost, it began to be the expense. There you go. If you keep that in mind, you'll never be audited by the IRS. Okay, you just need to learn to work your way through it. So that's an expense. Now, there are certain things that you do in your business that are not classified as an expense. It's called a draw. It's called a D. Draw. D for draw. Now, this is the way, folks, you pay yourself in a sole proprietorship. That's the way you pay yourself. You take a draw. Or D-R-A-W. D-R-A-W. You take a draw. A draw is something that you take out of the business, had nothing to do with the business. Because you'll see the word as you read the book called the matching principle, which means you must match the revenues with the expenses. An expense is something you had to pay in order to make the revenue. You got to equate those. If you buy something and you want to deduct it on your income tax, it must have been used to create revenue. So on your way home from work, your wife calls you on the phone, or your husband, and says, would you stop off at Walmart and buy some diapers, i.e. D, as in D. D for diapers, okay? D for drawing. He says, yes. On the way home, goes in, buys the diapers, goes home. Now, and then you want to show that on your income tax as an expense used in operating the business. Do you think the IRS is going to like that?
Only if you're running a daycare.
What's that?
Only if you're running a daycare.
Only if you're running a daycare. That is correct. Okay, so whenever you take something out of the business for your own personal use, has nothing to do with the business, is called a D. D for diaper, D for drawing. Now, knowing that, I have not even told you what its normal balance is, but can anybody tell me what the normal balance would be for a draw? A debit, right? It would be a debit. Because, all right? Yeah, because you bought diapers, that decreases owner's equity. You got it? Now, over here on the very end, there's this little thing called Ed. Uncle Ed. That is the exception to the language. Okay, in review. Everything on the left-hand side has a normal balance on the left-hand side. Everything on the right-hand side has a normal balance on the right-hand side, except for Uncle Ed, who has normal balances on the left. Now, this was my problem, and it better not be a problem for you. 4 hours in the library trying to figure out why an expense was a debit and an asset was a debit. And I went crazy. One time I worked in the language lab up at Utah State, German language lab. And I went up there, and I could find a place to study. They had an old table, the kind that had hearts scratched in it, and L somebody plus somebody else. Those old tables? Okay, been there for 40, 50 years. And I was studying at that old table like that, and I could not figure out why an expense was a debit and why an asset was a debit. I couldn't figure it out. And so I took this pencil. In my hand, and I drove it into that table. Oh, I sure hope they don't have videos any place watching that. And when I took my hand away, the pencil was sticking up in the table. I'd driven it right into the table. Okay, and my hand was bloody. It was ugly. Okay, because I couldn't figure it out. Now, can anybody tell me why an asset is a debit and why an expense is a debit? What's the basic rule of debits and credits? What's the definition of a debit? Left. What's the definition of a credit? Right. Okay, and you got this thing called the teeter-totter, right? It is a simple teeter-totter kind of a situation that you have to set up. And as you get into the language, it just flows. You see, expenses will be debits. It's got to be a debit because expenses are debits because it's a sad thing that it does to its partner. It rips off OE. When it rips off OE, you got to make it a debit. When you take money out to buy diapers, it rips off OE, and so you got to make it a debit because OE is a credit. You got it? And over here, it's a debit because it's on the left, and the rule is everything on the left's got to be on the left, and over here, the rule is it's just decrease. See that? You got that? Okay, give it some thought. Give it some thought. I'm giving you a lot tonight, guys. All right? And some of the stuff's going to go way over your head. But I promise you, you'll have that mind map down when we're done. Okay, now, let's go through, Matt, we're coming. We're coming now. Because now,